How does unearned income impact your tax return? Imagine earning money while you sleep or relax. That's what unearned income is. It includes interest from savings accounts, dividends from stocks, rental income from properties, pensions, social security benefits, alimony, and profits from investments. And like wages or salaries, unearned income comes without actively working for it. When you file your tax return, you need to report all unearned income you received during the year. This income is usually taxed at your regular income tax rates. But some types, like qualified dividends and long-term capital gains, are taxed at low rates, which can be a real benefit. For example, long-term capital gains are taxed at rates of 0, 15, or 20% depending on your total taxable income. It is important to note that unearned income is generally not subject to payroll taxes like Social Security and Medicare taxes. This means you won't pay those taxes on interest, dividends, or rental income, but you still need to report them. Your total taxable income is the sum of both earned and unearned income minus any deductions you qualify for. The more unearned income you have, the higher your overall taxable income becomes. This can push you into a higher tax bracket, meaning you might pay a larger percentage of your income in taxes. Some tax credits and deductions requiring you to have earned income to qualify. If most of your income is unearned, you might not be able to claim certain benefits, which could affect your overall tax savings. Keeping detailed records of all unearned income sources is very helpful. For example, save your bank statements showing interest earned, brokerage statements for dividends, and receipts for rental income. Accurate reporting is essential to avoid penalties or audits. For Asian American taxpayers, understanding how unearned income affects your tax return is especially important. If you receive investment income or rental income, these must be included in your taxable income. If you're relying mainly on unearned income and have little or no earned income, you might miss out on some tax credits or deductions. Consulting with a tax professional familiar with the US tax system can help you navigate these rules. They can advise you on how to report your unearned income properly and help you plan to minimize your tax liability. In summary, unearned income increases your taxable income and is taxed at your regular rates, with some types benefiting from lower rates. It does not incur payroll taxes but can influence your eligibility for certain tax credits. Properly reporting all sources of unearned income and understanding these rules can help you manage your tax return more effectively.